market. Today we have a very special guest with us, Mr. Ajay Marwaha.
All markets are studied in terms of prospective returns, risks, etc.
So how are these measures, to be looked at by FPIs?
So let me break up that question into two parts, right? By meeting a custodian, you will not get
the exact perspective of the foreign investor.
Exactly.
Right?
So that's one side of the story. The other side of the story is it's very interesting because some of these norms, again, there was media coverage on what FPIs want. If you roll back the press to 12 months ago, you'd see the same article.
Correct.
Nothing has changed, right? So whatever noise we hear in the system is pretty much the same. What are the constraints? The constraints is typically the 1-year norm is a big constraint, yeah. But in my view, you can keep drilling down and say the 50% is a constraint, the 20% is a constraint. But if you ask me, the broader consensus, what do FPIs want? FPIs want to ensure that when they come in as an investor, they are treated at par with an LIC, with an EPFO, with a State Bank of India, with a Prudential Asset Management, with a Reliance Asset Management. Basically, if you look at local domestic investors of size, they have a certain playing field.
Right.
The foreigner is coming in, if anything, as an external agency and willing to take risks in your country. The last thing you want to do is create a playing field for him which is more difficult than it is for your domestic investors. Let alone giving him SOPs. You don't want to make life difficult. If anything, you want to make life kosher, the same, right? So if you have domestic agencies which can trade in a certain way, invest in a certain way, please make sure that norms for foreigners remain the same. That's number one, from an investor perspective. There is another aspect of it, in my view, which is much, much wider than this. And I find some of the thought processes of the government are very positive when it comes to this ideation. However, the follow-on through the regulatory mechanism just doesn't seem to be working, right? I don't know where the slip is, right? Mr. Modi was in Wembley in London 3 years ago. He announced Masala Bonds. There was a lot of positive noises in that country since then. My experience over the years in Indians issuing paper has been that investors from the West have started to look at this much more actively than they used to.
Correct.
So whereas Singapore, Hong Kong was the easy destinations earlier, today, in my view, the focus has to shift to the West. Now, it can shift to London quite easily because the format of issuances remains the same, it's Reg S. The US is a little more difficult because you have to go to 144A, there are additional requirements, there are costs most importantly, and time kind of situations. However, in my view, both of these markets are relatively untapped.
Okay.
Yeah, the Indian story hasn't been told. We try and do what we can, but we're two souls on the street, right? So you obviously need a lot of this story to be told. That's number one. Number two, again, an Indian issuer who needs money approaches domestic investors and is allowed to sell a certain portfolio of instruments, right? So he can sell commercial paper, he can raise money through NCDs, 1 year, 18 months, whatever it may be, and he can also raise capital, right? Tier 2 debt or whatever it is.
Correct.
So that is the portfolio of issues that he can do and raise capital. When he starts to look offshore, there are two ways he can do this. He can do this in rupees, he can do this in dollars. I understand completely the mechanism that controls the flow of dollars into the country and onward into applications, right? So there are certain guidelines in terms of where foreign currency funds can and cannot be used. Completely understood, taken on board. When it comes to raising rupees from offshore, what I don't understand is why raising rupees domestically and raising rupees offshore is looked at in a different light. The risk, again, right? You are here trying to attract a bunch of investors from an overseas, an alien market, to come and buy paper which your domestic guys buy, right? But we want to make it harder for them to do so. It doesn't add up to me. What you've got to do, first case, is make sure whatever issuers can sell here, they can sell there.
So you mean to say on par, the
Absolutely.
framework and the regulations should be.
Should be. So this restriction, if somebody wants to issue a Masala bond, he can't do, he has to do minimum 5 years if he's doing more than 50 million. If he's doing 50 million, he can do 3 years minimum. We get relaxations. We had a relaxation recently. So a little bit of a joke. The relaxation was for manufacturing companies. They can raise up to 1 year. Which manufacturing company wants to raise working capital funding going through an offshore instrument? It's too expensive. They can raise enough.
Domestic.
Yeah, they can go to banks, they can do CPs, whatever, right? Who needs this money? Money is required predominantly by the NBFCs.
Right.
Yeah. The NBFC system in India is systemically very different today than it was 5 years ago. You have a handful of NBFCs and more who are 100,000 crores in size, 15, 20 billion dollars. These are large companies, large balance sheets. They are run far more professionally today than they've ever been.
Correct.
Yeah. Unfortunately, we had a serious situation in one specific NBFC, right? I think extrapolating that and looking at other NBFCs with the same lens is a huge fallacy. There have been repercussions of what's happened.
Correct.
But my opinion here is you have to open up the conduits for all of these entities who need financing to go get financing offshore as well as onshore.
Right.
And let them borrow from wherever they think it's cheaper.
Right.
If offshore investors believe risks in India are too high, whether it's politics or otherwise, they will add a certain premium, to what they need. And therefore, it may be expensive to raise money from offshore. And some companies may choose not to do it. But that choice should be left to the investor, to the issuer, and therefore to the market. There doesn't need to be a regulatory framework. Either, I'm not saying there should be a regulatory framework to encourage the flow. Neither am I saying there should be a regulatory framework to impinge on the flow. Correct. It's got to be free.
Right.
If it happens, it happens. It happens because of market reasons. It doesn't happen because of market reasons. Let the companies make the effort of going and woo investors offshore. And let the investors understand Indian credit better.
Right.
That's the way you should allow the system to grow.
I think that's a very valid, appeal we can do to the authorities, probably to, enable this free flow of trade, which should be happening between the issuer and the investor, which will make the, economy more vibrant and, a little more smooth going process.
Absolutely.
I would say.
Absolutely.
Great. So one more important question I would like to ask you. What is your stance on Fed's, rate hike cycle? Do we see, some FPIs, coming back because of that? And what exactly is your take on the Fed stance?
I think there are a couple of issues there, right? Like in some other countries we've seen, there is a push-pull between the political kind of agenda and the monetary agenda in the US as well today, right? I think the presidency kind of at the moment believes that incremental interest rate rises will defeat what the presidency stands for. The presidency stands for, free flow of funds, increased profitability, lower taxes, increased demand. And that is something that is being challenged if you see a series of hikes or a continuing series of hikes in rates. However, I think the Fed is clearly on a macroeconomic stability path. I don't think the Fed is going to be driven beyond a point by all of the noises coming out of the presidency or the political kind of climate in the US. At the moment, US growth was seen stuttering a little bit, but still is on a very rock solid path.
Okay.
So to actually try and discount the fact that the Fed won't hike anymore, I think will be a fallacy. The market's not doing so. The market's kind of tried to normalize the dot plot a little, so interpret the dot plot a little less aggressively than it was doing earlier.
Right.
So you might basically see 50 basis points of hikes this year rather than 75 as earlier projected. But you're on a trajectory in any case, which we call late cycle, okay. Right? So you don't expect, or you never did expect, US rates after they had crossed 2.25, 2.5%, to be on an aggressive raising path.
Right.
So that trajectory is pretty clear to investors. Um, there's been a significant kind of rally in the 10-year, as you've seen, right? From the north of 3%, we've kind of traded down to 265. That kind of rally is something that only happens when there is a risk repricing. I think some of this may be slightly knee-jerk.
Okay.
You will see, the curve kind of going back and steepening to some degree. However, I also think that it's an encouraging sign for investors into US fixed income. Again, just like Indian credit spreads are attractive, credit spreads in the US also are attractive. So you will see flows continuing to go back to G3. Whether they will be at the expense of EM flows and which EM flows will be compromised is for us to see. But I think the US fixed income markets are an attractive market and will continue to look attractive to most large fixed income investors over a period of time.
So, are you trying to say that the Indian markets will still see a very subdue of flows from FPIs in 2019 as well, if any of good measures from the authorities are not announced yet?
No, I don't think you can put a gun on any authority's head. I think a better way of assessing the situation would be it's only normal to estimate that the first 2 quarters would be guarded. Okay. FPIs would look at India positively. Structurally, I think India is a very solid country from an investment perspective, and that would continue. However, there is an event. It's a significant event. It's not an earth-shattering event. Elections happen in this country every 4.5 years. So, it's an event. Like I said, some of the concerns re the event are that the ruling party was unable to perform to the extent people had assumed it will. And that is causing a little bit of a ripple in terms of people raising eyebrows on risk. How that pans out, we'll have to see. Okay. I think the 3rd and 4th quarter of this calendar year will look slightly different from an FPI perspective. There are going to be external factors dictating that. So oil has to be supportive, for example. But I think what will be important is to understand how the new government looks. An important factor outside of the new government we keep forgetting about is the monsoon. Right. The last 2 years, we've seen monsoons which in percentage terms have looked okay, but if you look at the rainfall distribution patterns, they've not been okay. You've seen crop issues in all the 3 states in which the ruling party has lost the election. Not all of those crop issues are because of policy. Right. A lot of those crop issues are because the crop actually didn't do well in those states. And that's a rainfall driven situation, right? So you can make politics out of anything, but you can't make anything out of politics, right? Politics is a science in itself. You should leave it aside. I think when you look at it scientifically, you will see a situation where the next 2 quarters in this calendar year will look better from an FPI perspective, from a certainty perspective. Okay. Most of the uncertainty will be out of the way. So India, to summarize, will remain structurally important. I don't think that goes anywhere. The low inflation, steady rupee, repriced rupee will be very supportive for flows. Concerns on the election will continue until they're out of the way. Post that, assuming the macro scenario remaining supportive, you could actually see very encouraging flows into Indian fixed income.
Great. So one last question just to end this very interacting session. I would like to know, the corporate bonds which we have seen, the basic main fundamental which the issuers use. Like for example, the issuers who have distributed branches in offshore as well as onshore. Yeah. So only those companies are seen to be a slight active in Masala Bonds or in dollar bonds. So we have seen, like recently Indian Oil Corporation is there, which is trying to pitch in 5-year bond. That company already has offshore projects as well. So I don't think they would be finding it any problem in such a scenario. Even the currency appreciates or depreciates, they can anytime pay back and use the funds offshore itself, or if in case it is in rupee terms, they can anytime come over here. So are we seeing these companies to be the only issuing one, or are we seeing some new incumbents to come in, looking at, you know, the Fed coming to a little less aggressive stance, and, you know, being India a fundamentally strong investment avenue? So are we seeing that to come in?
So I think currently the bunch of companies which have been in the press in terms of, you know, the ones expected to do roadshows, etc. I think they are more raising dollar funds. Particularly people like IOC, etc., are regular issuers in the dollar market.
Correct.
And they're need-based opportunistic issuers. And we've seen that, you know, this is the beginning of the year is a good time to go and engage with investors or consider coming out and using it as a window to issue. So that's what you're seeing.
Okay.
As far as the second part of your question in terms of what is the issuer universe as far as Masala Bonds is concerned. I think frankly Masala Bond universe has to be dictated only by 2 or 3 main criteria. The most important criteria is a certain consolidated size that the entities need to have. I think in India we have a handful of entities which are, you know, easily crossing those thresholds of size. However, clearly along with that, complementing that, there needs to be an awareness in the issuer that they are talking to an international investor. So international ratings are a very important ingredient of a successful set of bond issuances. You can probably get away with 1 or 2 issuances without a rating, and if you're a name like HDFC, which has done so well over the years and has a fantastic track record with equity and debt investors now, you can probably get away with unrated paper. For a lot of other Indian names who can and should issue rupee paper offshore, they do not have a track record offshore with investors. They have to actually go and tell their story, which was something that I mentioned earlier.
Yeah.
But that universe is wide open. I mean, I would say today there are about 40 entities in this country which can actually access that market with the appropriate building steps or start, you know, and those stepping stones have not been placed yet.
Okay.
Companies have, well, some of them have moved 1 or 2 degrees forward, but most of them are still thinking, looking, assessing, and I think the other thing is they've been pampered by domestic issuances, right? So domestic markets are cheap to issue, it's easy to get money. When do we start looking at the offshore conduit? When we see September 21, right? When you see situations where liquidity dries up, suddenly, oh my God, I'm not getting any money here.
Yeah.
But for companies which have opened this conduit, accessing this conduit is something that is not seasonal.
Right.
It becomes a part of your process.
Correct.
Your liabilities can have, and you can budget to have a certain portion of your liabilities coming from offshore. Offshore investors are loyal to credit. They're not loyal to any company or any corporate, but they are massively loyal to credit. India is a 12% nominal growth economy broadly. If a well-run company continues to maintain or grow market share, you know, it will achieve a very, very healthy growth in balance sheet and credit quality, well run.
Correct.
And therefore, you can expect international investors to continue to remain loyal through that, and therefore continue to provide you avenues of funding. I think that's the message which issuers have got to read. Investors are waiting, quite frankly, for this to mature, this whole phenomenon to mature, and regulators have got to be sympathetic to and actually encourage some of these flows to take place.
Right, definitely. Thank you so much, sir. It was an amazing session with you. Would
Thank
love
you.
to have similar other sessions if we get some time.
Sure.
It was
Sure.
great having you here.
Thanks for getting me here. Thank you.
Thank you for watching Ticker Market.